Welcome back to the deep dive. Today we are doing something a little different from our usual format.
We are indeed.
Yeah, normally we look at a specific company, we analyze its stock, maybe pull apart a new product launch, and then we move on. But today we're looking at an institution that is, well, it's less of a company and more of a gravitational force. We're talking about the absolute elephant in the room of Indian finance.
That is a very apt way to describe them.
I think so. Because, if this institution sneezes, the entire Indian economy catches a cold. We're talking, of course, about the State Bank of India, or SBI. And looking at the stack of research you brought in today, I'm honestly a bit conflicted.
How so?
Well, on one hand, I'm looking at a government bureaucracy with a history that goes back over 200 years to the Bank of Calcutta in 1806. But on the other hand, I'm seeing performance numbers here that look like they belong to a nimble, high-growth fintech startup.
It really is a study in contrast, isn't it? And that's exactly why this deep dive is going to be so fascinating for everyone listening. We're trying to answer a core question today. How does a legacy giant, with all that 200-year history, suddenly decide to just start sprinting?
Right. And to figure that out, we've got two very distinct lenses to look through today.
We do. First, to understand the foundation, we're pulling from a credit rating rationale from ICRA. That one is dated October 13th, 2025.
So that's our baseline.
Exactly. Think of the ICRA report as the structural blueprint of the bank. How safe is the building, essentially? Then, to see what is happening inside that building right now, we have a very fresh equity research report from Way2Wealth, dated February 12, 2026.
Right, covering the Q3 FY26 financial performance.
Yeah. So we have the safety inspection and the quarterly report card.
Okay, so before we get to the profit numbers, which honestly are completely staggering, we need to set the stage. You called it the structural blueprint. When we talk about SBI, we aren't just talking about a big bank. There's a very specific regulatory term for what they are.
Yes. They are a DSIB.
A DSIB, which sounds a bit like a computer part, but what does it actually mean?
It stands for Domestic Systemically Important Bank.
Got it.
And in plain English, that simply means they are too big to fail.
We hear that phrase thrown around a lot, too big to fail.
Yeah.
But what does that actually look like on the ground in the Indian economy?
It means that if this institution were to stumble, it would cause massive, widespread disruption to the essential services of the entire banking system. Just look at the market share. As of March 2025, SBI held 22.8% of all advances.
So that's all the loans given out in the country.
Right. And they hold 23.7% of all deposits.
Wait, 23.7. So almost 1 out of every 4 rupees saved in India is sitting inside an SBI account.
That's right. And that kind of scale provides a safety net that private banks simply cannot replicate. Because, and this is the crucial part for the ICRA rating, the government of India holds roughly 55% of the equity. That majority sovereign ownership is the absolute bedrock of their AAA credit rating. It's the ultimate backstop.
Right. But there's a flip side to that, isn't there? Being big and government-backed usually means you're slow, you're inefficient. But looking at the physical footprint outlined in the ICRA report, the reach of this bank is it's vast.
It is entirely unmatched. As of June 30th, 2025, they were operating 22,980 branches.
Almost 23,000 branches. I'm just trying to visualize the logistics of that. That is more branches than some small countries have people.
It creates a logistical footprint that is arguably one of the most dense and far-reaching in the world. You will find an SBI branch in remote Himalayan villages, on islands, places where there might not even be a paved road.
And for you listening, this isn't just about financial inclusion or charity, right? This massive physical network is actually the core engine of their business model.
Oh, absolutely. It acts as a giant vacuum cleaner for low-cost deposits.
Yeah.
Which brings us to a metric we talk about quite a bit on the deep dive.
The CARSA ratio, current account savings account.
Exactly. Money sitting in current accounts pays 0 interest. Money in savings accounts pays very little. For a bank, deposits are the raw materials.
Right, you take deposits and turn them into loans.
Yes. And if you can source your raw material cheaply, your profit margins on the finished product are naturally going to be higher.
So because SBI literally has a branch on every corner of the country, they can just scoop up all this cheap cash.
That's the secret sauce. ICRA notes that SBI's domestic CASA ratio was at 39.4% in June 2025.
39.4. How does that compare to their competitors?
Well, compare it to the average public sector bank, which sits around 36.7%. Now, A gap of 2 or 3% might sound small on paper.
But at their scale.
Exactly. When you are dealing with trillions of rupees, that slight percentage advantage is a massive competitive moat in the cost of funds.
They're basically getting their money at a discount compared to everyone else.
They are, and that leads to incredible liquidity.
Yeah.
Their liquidity coverage ratio was roughly 136% in that same period. They are quite literally swimming in cash.
Okay, so we've established the fortress. They're huge, they're everywhere, they have sovereign backing, and they have an endless supply of cheap money. Usually when I read a setup like that, the next sentence is, and so they coasted along, growing at a comfortable 5% a year.
And that is exactly where the Way to Wealth report throws us a massive curveball.
Right. Let's get into this magnificent showcase, as the report calls it. We're looking at the data from February 2026. What happened in the third quarter?
They posted a profit after tax of PATAs of 210 billion rupees.
210 billion in a single quarter.
Yes, that is a 24.5% jump year on year.
Hold on. A 200-year-old government-backed institution growing its profits by a quarter in a single year. That doesn't sound like a slow-moving utility. How are they pulling that off? Are they just jacking up the interest rates on all their loans?
Well, it's a mix of things. Their net interest income, which is the core money they make from lending, was up a solid 9% to 452 billion rupees.
Okay, 9% is good, but it's not 24%.
Exactly. But if you dig down into the other income line item on the statement, there's a fascinating story playing out.
I saw that in the notes. There was a specific mention of a dividend payout.
Yes, a 22 billion rupee dividend, specifically from SBI Mutual Fund.
I think this is something people often forget.
Yeah.
When you hear SBI, you picture the bank branch next door.
Right.
But they aren't just a bank, are they?
No, they are a massive financial conglomerate. They have subsidiaries handling life insurance, general insurance, credit cards, asset management.
Right.
That 22 billion check from the mutual fund arm is proof that they are actively unlocking the value trapped in those subsidiaries. They aren't just making money off lending anymore.
They're managing wealth. They're taking on insurance risk.
Facilitating credit card payments. All of it. That one dividend payment alone helped boost their entire other income segment by over 66% year on year.
Wow. So they have these multiple revenue engines firing all at once. But I want to pivot back to the lending side for a second, because there's one statistic in the Way to Wealth report that genuinely stopped me in my tracks.
I think I know exactly the one you're talking about.
The gold loans. The report states that their gold loan portfolio expanded by roughly 95% year on year.
95%. It effectively doubled in 12 months.
Okay, let me play devil's advocate here. When I see any bank, but especially a public sector behemoth doubling a specific loan book in just a year, all my alarm bells start ringing.
It sounds like a red flag.
It smells like reckless lending.
Yeah.
Like, are they just handing out cash to anybody who walks into a branch with a gold chain? Why the sudden aggressive push into gold?
It might look reckless from the outside, but it's actually a highly calculated war for market share. You have to understand the historical landscape of gold lending in India. For years, that specific market was completely dominated by specialized non-banking financial companies, NBFCs.
Right, like Muthoot Finance or Manappuram. The places with the huge billboard saying gold loan in 5 minutes.
Exactly, those guys. And those NBFCs charge pretty steep interest rates, sometimes 12%, 15%, or even higher.
Why so high?
Because their cost of funds is high. They don't have thousands of branches pulling in cheap savings accounts. They have to borrow money from the market just to lend it out to their customers.
Oh, I see. Whereas SBI, as we just talked about, is sitting on a literal mountain of cheap Corsair deposits.
Precisely. Someone at SBI realized they were sitting on a gold mine, pun absolutely intended. They have the ability to offer gold loans at significantly lower rates than any NBFC and still turn a very healthy profit margin.
So this 95% growth isn't necessarily new people suddenly needing gold loans.
No, they are aggressively stealing lunch from the NBFCs. They're using their massive size and their incredibly low cost of funds to just price the competition right out of the market.
It's a full-blown price war.
It is. And for a bank like SBI, it's a brilliant product to push. It's fully secured. If the borrower defaults, the bank holds the physical gold. It's highly liquid. And it allows them to diversify their massive loan book away from just huge corporate clients.
Okay, but still, 95% growth. Surely there's some operational risk there. What if gold prices tank? Are they valuing the collateral correctly?
The Way to Wealth report actually addresses that directly. Their loan-to-value ratio, or LTV, is around 54.89% for agricultural gold loans and about 51% for personal gold loans.
Wait, so if I walk in and hand them 100 rupees worth of gold jewelry, they're only giving me 50 rupees in cash?
Correct. Which gives the bank a massive buffer. The global price of gold would have to completely crash by nearly 50% before SBI even risked losing their principal amount.
Okay, that makes a lot of sense. That's a huge margin of safety. But there was another metric tied to this that I found surprisingly reassuring. The auction data.
Yes, the auctions are the real pulse check on a gold loan portfolio.
The report noted there were only 20 to 30 auctions across the entire massively expanded book.
Which is incredibly, almost unbelievably low for a portfolio of that sheer size.
What does that actually signal to us? Beyond just telling us that SBI's balance sheet is safe.
It tells us a lot about the health of the average borrower. In India, gold isn't just a financial asset, it's a deeply emotional one. Families absolutely do not want to lose their ancestral jewelry.
Right. It's a last resort to pawn it and you intend to get it back.
Exactly. So if auctions are that low, literally just 20 or 30 cases where the bank had to sell the gold, it implies that these borrowers, who are mostly in rural and semi-urban areas, are generating enough income to pay back the interest and redeem their assets.
So it's actually a proxy for rural economic health.
It is. It suggests that the distress in the rural economy might not be quite as severe as some of the broader macroeconomic headlines sometimes suggest.
That is a really sharp takeaway. Okay, so the gold strategy is booming and it looks safe. But look, we can't do a deep dive on the State Bank of India without talking about the ghost in the machine.
Asset quality.
Right, because if we rewind the tape to, say, 2017, 2018, 2019, the headlines were brutal. It was all about NPAs, bad loans, massive corporate defaults. It was an ugly time.
It was a very dark period for the sector. Fresh slippages, which are good loans suddenly turning bad, were consistently ranging between 3% to 11%. It was acting as a massive drag on the entire Indian banking system.
So sitting here in 2026, has that ghost finally been exorcised? Or are they just hiding the bad news in a different closet?
The hard data suggests a genuine structural turnaround. Today, the gross NPA has dropped down to 1.57%.
Wow.
But the real number to focus on is the net NPA. That's the bad loans minus the cash provisions the bank has already set aside to cover them. That number is sitting at 0.39%.
0.39%. I mean, that is razor thin. Is it almost too good to be true for a public sector bank?
It's essentially private sector bank territory.
Let me put my cynical hat on for a second. Are they ever greening? You know, are they just quietly restructuring bad loans to make the spreadsheet look pretty?
Well, you have to look at the provision coverage ratio, the PCR. It currently stands at 75.5%.
What does that mean in practical terms?
It means that for every single rupee of bad loans on their books, they have already taken 75 pays out of their profits and locked it away to cover the potential loss. That is a very aggressive, very conservative stance to take.
Okay, so they're well insulated.
They are. However, ICRA did flag one specific thing to keep an eye on.
Right, I highlighted that. They called it the monitorable vulnerable book.
Exactly. ICRA noted that SBI has a slightly higher share of restructured advances. These are loans where the borrower struggled, and the bank essentially said, okay, you can't pay under the original terms, so let's extend the timeline or change the interest rate to help you out.
Which, to be fair, can sometimes just be a polite way of delaying inevitable default.
It definitely can be. But ICRA still reaffirmed their top-tier AAA rating. They basically concluded that even if some of those restructured loans go completely sour, the bank's capital cushions and their current operating profits are so massive that they can easily absorb the shock.
They aren't worried about it bringing down the building. They just want to make sure the fire extinguishers are working.
Precisely. It's a monitorable risk, not a systemic threat.
Speaking of capital cushions, we should probably talk about their war chest. Because you don't confidently upgrade your loan growth target to 15% unless you've got fuel in the tank.
And this is where their financial strategy gets really interesting. Back in July 2025, SBI went to the market and raised 25,000 crore rupees in equity through a QIP, a qualified institutional placement.
25,000 crore. That is a lot of zeros. But help me out here. Why did they even need to do that? We just spent 10 minutes talking about how they're drowning in cheap deposit money. Why sell off equity?
This goes back to a fundamental concept in banking leverage. You cannot just take deposits and lend them out infinitely. Regulators require banks to maintain a base of pure equity capital to absorb unexpected losses.
Okay.
By raising that 25,000 core in pure equity, they aren't just putting cash in the vault. That equity acts as a lever. For every 1 rupee of pure equity capital a bank holds, they are legally allowed to safely lend out maybe 8 or 9 rupees of those deposits.
Oh, I see. So that 25,000 core is like seed corn. It unlocks the ability for them to expand their actual loan book by potentially 200,000 core or more without upsetting the regulators or the rating agencies.
Exactly right. It's dry powder. Raising that equity proved they were preparing for a massive expansion cycle. It totally validates their giants upgrade.
Right, the Way2Wealth report mentioned they bumped their loan growth target for FY26 up from 12 to 14% to a new target of 13 to 15%.
Right. And you just don't make that kind of public commitment unless you have the capital base already locked in to support it.
Okay, so let me summarize what we have so far. We are looking at a bank that is growing its loan book aggressively. They are earning record-breaking profits. Their books are the cleanest they've been in a decade, and they are sitting on a massive war chest of capital.
Yes.
It sounds like the perfect stock to buy. And yet, the Way2Wealth report issues a hold recommendation.
They do.
Why ruin the party?
It all comes down to valuation. As of February 12, 2026, the current market price was 1,182 rupees and 90 paise. The analysts are saying, yes, it's a phenomenal institution, but you might want to just hold your existing shares rather than buying new ones at this price.
Because the secret is already out.
Basically. The stock is currently trading at 1.2 times its estimated FY28 adjusted book value. The market isn't blind. Institutional investors saw these good numbers coming from a mile away.
So the magnificent showcase is already fully priced into the stock. Yeah.
Likely, yes.
Yeah.
The easy money from the turnaround has already been made. And looking ahead, there are some very real headwinds on the horizon. We really need to talk about NIM compression.
Let's unpack that term for the listeners. ENM is net interest margin.
Think of NIM as the bank's markup. They buy money from depositors, they sell it to borrowers, and the difference is their margin. Currently, SBI's domestic NIM is sitting at a very healthy 3.12%.
Okay, that sounds good.
It is good. But both reports note an expectation that the central bank might start cutting repo rates in the near future to stimulate broader economic growth.
And if the central bank cuts rates, that's bad news for the bank's margin.
Usually, yes.
Yeah.
Because when the repo rate is cut, a bank is under immediate regulatory and competitive pressure to lower the interest rates they charge on things like home loans and corporate loans. Those are often linked directly to external benchmarks.
So their income drops almost overnight.
Exactly. But the interest they pay to you on your fixed deposit or savings account, they can't drop that quite as fast. Retail deposits are sticky.
Right, if I have a fixed deposit, the rate is locked in.
Exactly. So their income drops faster than their expenses do. That squeezes the margin. That is the compression risk both ICRA and Way2Wealth are warning investors about.
That makes total sense. And I noticed another dynamic in the report regarding exactly who they are lending all this money to. Corporate lending is really picking up. It grew by over 13%.
It did.
Now, normally we think huge corporate growth is a great thing. But doesn't that also hurt their margins in a way?
It's the classic trade-off between volume and value. If SBI makes a massive multi-billion rupee loan to a blue-chip conglomerate like Tata or Reliance, that loan is incredibly safe. But because those companies have stellar credit ratings, they demand lower rates. You can't charge them 12%. You might only charge them 7 or 8%.
Whereas the guy coming in to pawn his gold jewelry is paying a premium.
Exactly. So as that ultra-safe corporate book grows faster, the average yield across the entire portfolio might dip just a little bit. It adds huge, safe volume, but it's a thinner slice of profit per rupee lent.
So the hold rating isn't a red flag. It's basically saying, look, this is a great bank, the performance is stellar, but the macroeconomic future might be just a little bit tighter than the recent past.
That's exactly it. It is just a prudent, realistic view.
Okay, let's try to pull all these threads together. We started off by calling SBI the 800-pound gorilla of Indian finance. We've looked at their massive safety net, the surprise explosion in profits, the absolute gold rush they're leading, and the somewhat sober valuation reality. If you had to summarize the state of the state bank right now, how would you frame it?
I think the best way to put it is that the sleeping giant hasn't just woken up. It's woken up drank a pot of coffee, and started doing high-intensity cardio.
I love that.
But seriously, the transformation from a somewhat sluggish, traditional public sector entity to a highly aggressive bank that can double its gold loans in a year and post a return on equity hovering near 20%, it's remarkable. It proves that even a legacy institution with 200 years of baggage can pivot if the strategy and the leadership are aligned.
And for you listening, why does all of this actually matter, assuming you aren't just day trading the stock?
It matters because SBI is the ultimate proxy. If SBI's management is confident enough to raise their growth targets and raise capital, it means they're seeing real, tangible demand on the ground. They're seeing factories getting built, infrastructure projects moving forward, and everyday consumers taking out mortgages. When this particular gorilla decides to run, it's usually the best signal we have that the broader economic jungle is very healthy.
That is a phenomenal takeaway. But I know you, and I feel like you have one more thought lurking there. You always like to leave us with a bit of a curveball.
Well, I do have a question that I think anyone looking at this space needs to ponder. Right now, we are all celebrating SBI's incredible profitability. A 20% return on equity is fantastic. It's what you expect from a top-tier private bank.
Right. Shareholders are thrilled.
But we have to remember the foundation we started with. This is a DSIB. It is majority owned by the sovereign government. Its ultimate mandate, historically, is to support and stabilize the Indian economy, not purely to maximize shareholder profit.
Oh, I see where you're going with this.
Right now, the economy is booming, so the bank's purpose and its profit are perfectly aligned. But what happens if the economic cycle turns? What if there's a global recession? Will SBI be permitted to remain this fiercely profitable and selective? Or will the primary shareholder, the government, step in and say, okay, the party is over. We need you to lend heavily to struggling sectors or fund long-term infrastructure, even if it severely damages your margins?
Can the elephant keep dancing like a gazelle when the music stops playing?
Exactly. Can it realistically serve two masters in the long run? The minority retail shareholder who demands high profits, and the sovereign owner who occasionally requires economic sacrifice. That is the underlying tension everyone should be watching.
That is the billion-rupee question right there. Are they a profit machine or a public servant? I guess we will just have to wait for the FY27 annual report to see how that balancing act plays out.
Indeed we will.
Well, thank you for walking us through that massive maze of billions and percentages. And to you listening, thanks for diving deep with us once again. We will see you next time. Keep learning.